To be honest, it's really important you grow a small account safely and consistently. I was doing the research, and if you buy a call option right before earnings in a specific way, which will be the first of the 3 cheap option trading strategies I'm going to discuss in this video, then you can 10x your money short term. But I'm also going to continue to open a couple other cheap strategies to show you the ridiculous amounts of money that you could be earning in 3 different ways. As always, I'm going to focus on consistency. I don't like peaks and valleys in my portfolio. My portfolio, in fact, is very stable. As you can see by the open positions I have, most of them are at a gain. Yes, I have one big loser at 860, but I also have a really big gainer at $24,000. The smartest people that want success apply for my private Discord community because they want to watch me trade and they want to get consistent. It's not because they want to get rich quick. It's not a sprint, guys. We want to get rich for sure. Getting rich quick sounds good, but it's not really cool when you have losses. It's not really cool when you make $3,000 one month and the next month is negative $7,000. I'd rather make $2,000 a month, or heck, for me, $40,000 a month consistently, or just focusing on a daily amount as well, like $100 a day or $500 a day. That's way better than going for inconsistent home runs. So the number one strategy that I want to talk about is buying call options before earnings. So here's Amazon. I think Amazon is a really good value play right now where you can buy a call option right before earnings, because statistically, when you buy a call option right before earnings on tech stocks, it typically works out really well based on historical data. The most successful traders want to buy in the money call options, which I'm about to show you. For Amazon, it's down 30% in the past 3 months, which is a ginormous plunge in the stock. And if we actually take a look at when they report earnings, it's on February 2nd. As I'm making this video, it's about a month and a week out. And that's actually pretty perfect because I do like buying call options before earnings, but I don't want to actually buy the call options 3 to 5 days before earnings because that's when volatility is very high. In fact, if you're a little bit earlier into the game, you can participate in the stock having a really good earnings period, making a lot of money without having to pay the premium price. So you can actually get a call option on a big discount. Now we're going to talk about buying a call option, managing it, the expiration date, the strike price, the break even. I mean, heck, there's a lot. So please watch this video. Don't skip around, okay? The first thing I'm going to do is buy call option. The earnings on Amazon is on February 2nd. That means that I need to include February 2nd into the expiration date. The best date for that is going to be February 17th, as you can see right here. If there was a date like February 3rd, I would go for February 3rd. But at this moment in time, that is not available. So I'm going to pick the first date available after the earnings day. Now, Amazon is currently trading for $86. What I want to do is I want to buy a call option that is slightly in the money, okay? In the money means that the strike price that I'm going to pick, the 85, is a little bit lower than the current stock price of 86. Now, if I expand this option, there is a big reason why I want to do this. The reason is because here, the delta is 0.55. I don't want to go too low on delta because if I pick a delta of 30, I'm only going to win about 30 out of 100 times. I also don't want to pick a 90 delta because that's going to be very, very expensive. In fact, if you notice here, the lower that I go, the more in the money the option is, the more expensive it becomes. You can see here how it's $1,700 and $2,100. That's not really good if you want to grow a smaller portfolio. You don't really want to risk that much of your portfolio, but you still want to have all of the upside and all of the gains. So right here, I'm going to pick the 85 call option. It's only going for $700. Now, I can control 100 shares of Amazon for $700 instead of buying 100 shares for $8,600. I'm getting less than 1/10 of the price. And something really important that I'm going to look for when I'm buying a call option is not only that the delta is around 55 to 60, this right here is good, meaning it's not too far out of the money, giving me a low chance of success, and it's not too in the money, making the option really expensive. This right here is going to be successful 55% of the time. Looking at the volume is actually great. In fact, this is really interesting. The open interest is 3,600 and the volume is 3,900. So the volume today has actually just peaked. This has become a very attractive option. And I suspect that's because there are some smart option traders out there that are copying my strategy. And this might be the Wall Street people, this might be hedge funds, I'm not really sure, But they have realized that this is a smart option to play, specifically because Amazon is down a lot. So again, the expiration date is going to include the earnings period. The strike price I'm going to pick is going to be just in the money, just a little bit. So check this out. I'm going to go ahead and buy this right now. And it's really important to understand that the maximum amount of money that you can lose on this position is $715. As opposed to buying the stock, if you were to buy 100 shares, well, your maximum loss would be the 86 times 100 shares, which is $8,600. You are risking way less money by buying a call option, and your max profit is still unlimited. Now, the only downside is, because nothing is perfect, there's always a trade-off with options, is here you do have some room to break even. So notice right now the price of the stock is 86, but the break even is actually 92. That's because you have to add the strike price plus the premium that you are paying for this call option to get the break-even price of $92. However, the stock is down 30%. So you really have to ask yourself, if Amazon does well in the next 5 weeks and earnings are good, can this stock pop 15%, 20%? And the answer is absolutely. This is actually a proven strategy that I've used and I've learned from my time at Goldman Sachs. And the beauty is, by getting into a call option earlier, you don't have to pay the same price everyone else is paying 3 to 5 days out. You can pay a very reasonable price and get a lot of extra time benefiting your call option. This is how I take advantage of volatility. Yes, this option is going to be negatively affected by theta. This option is going to decay. However, it's not going to decay as fast as buying an option 3 to 5 or even 7 days before earnings. I like to get in a little bit earlier and establish my position. This is a fantastic way to leverage a small account and get a very huge return, sometimes 10 to 20x on your money. Now, the next strategy that I want to talk about is going to be on American Airlines. And I'm going to take a look at the technical analysis, because understanding technical analysis is very, very important for the iron butterfly, okay? So I don't really care what you call it. What I'm going to focus on right now with this second option strategy is actually taking advantage of volatility not being so high. Finding a stock that is trending sideways and not necessarily going anywhere. Because if you check this out, on June 21st, 2022, American Airlines was at $13. And guess what? Over the next 6 months, this stock has went up and then down, and then went up and then down. Very predictable. Up, and then it did break support. It did go a little bit more down than it has been in the past 3 months at that point, but then it goes back up, and now it's coming back down. And if you actually realize that over the past 6 months, this stock has done absolutely nothing. This stock has not really trended any one way. It has not had a lot of momentum on the upside, breaking out, and it has not had a lot of momentum on the downside, falling down or going bankrupt or anything like that. And to be honest, that's not going to happen to American Airlines. It has a lot of support from the government. This stock does not have a good balance sheet. However, it is an essential in the economy because people are going to have to fly. So this is a very interesting stock to play this next strategy that I'm going to discuss. And this next strategy specifically to me is the ultimate small account strategy. I've done this so many times where I put in $100 and I've gotten $1,000 out. I've literally 10x'd my position on this type of trade. And this one, you can't skip the explanation, because to be honest, to be completely transparent, it is the hardest position to manage. Again, this position is so hard to manage, and that's why this strategy is not my favorite strategy, but this strategy can yield 10x, 20x, and even 50x returns. And Coach Henry is going to walk you through how to best open this position, manage this position, and also close this position. And I think this is super beneficial because a lot of people think that you need a large account to make money. And that is simply a myth. It's not true. You can absolutely grow a small portfolio. And this strategy that I'm going to show you on American Airlines is literally the best strategy to growing a small portfolio. But again, it is hard to manage. So there's a specific way to do it. So let's pull up American Airlines. And again, if you take a look at the chart, it's hovering right around $12.53 right now as I'm making this video. But again, I'm not a financial advisor, and you don't have to do this exact trade. What I want you to do is I want you to learn from this video, and if you're watching this in the future, find a stock in a similar pattern and abuse the same strategy and the same concepts that I'm teaching you in this video into the future. So my assumption on American Airlines is this stock is going to continue to trade sideways. Yes, over the past 3 months, it's down like 10.92%. If I go to the 1 year, it's down 23%. So yes, on paper, this stock is down, but in 1 year, this is actually not that much movement, and this stock is very predictable, and it's predictably moving sideways. In fact, I've been running this strategy on this stock for over 2 years now. The first thing that you're going to want to do is you're going to go to trade American Airlines options. Now, what I like to do is I like to go for weekly options with this strategy, and that's because it's a lot easier to manage and bet and actually have a profit and gain without having to have too much stress, without having to have the stock move crazy in one direction. If you trade this strategy on a weekly basis, not too much happens in one single week. It's very important that you manage this position properly because it is literally the difference between making a lot of money or closing this for break even or even a loss. So the first thing that I'm going to do is I'm going to go to sell call option. Okay, the expiration is the 23rd. I'm gonna go a little bit farther because that is only 2 days, and it's okay to go out about 7 trading days or even 8 trading days into next week. So what I wanna do right now is I'm gonna go to sell call option. The first strike that I'm going to pick is going to be our anchor point. It's going to be the top of our Christmas tree. This is basically the very peak where you want the stock to ideally end at on your expiration day of December 30th. Now, I'm a little bit bearish in the short term, but not by much. I think American Airlines is going to basically trend sideways and maybe 1% lower. So what I'm going to do is I'm going to create my peak of my Christmas tree, or the peak of this strategy, right at the 12.5 strike. The delta is 0.53. The volume is huge, which is very good, by the way. You want an option to have good volume because the bid and ask spread here is phenomenal. If this is wide, you're going to have the worst time with this strategy. I can't tell you how many times I've gotten a YouTube comment telling me I can't close this position. That's because you've picked the wrong stock and you've completely picked a stock with very bad bid-ask spread. And very bad meaning it's very wide. So this might be 35 and this might be 55. Yeah, good luck, because this option strategy is going to include 4 different option orders in one. It's going to be very interesting and very customized. It's very profitable, but if you don't do it profitably, then you're gonna have a very tough time. So I'm gonna go ahead and open this sell call at 12.5. Okay, that's going to be my anchor. And now I'm going to buy around this area. Okay, so I'm going to go one lower, so down to 12, going to buy the 12. I'm going to go one strike higher from the 12.5 anchor to 13. Okay, just going to open the 13, make sure that the bid ask is still good, and that is correct, it is still good. Okay, so I'm going to open up the 13. Now check this out, very important. This position is not complete. If I go to continue, it does not look right. And the reason for it is this actually has to be a custom order, okay? The custom order needs to include a unique ratio. And the unique ratio is for every sell, there has to be a buy. Again, look, there is 2 buys and 1 sell, and that is not correct. So what you want to do is you want to delete the 1 sell and make sure that you're actually going to sell 2, okay? So this needs to be 2. Now, this is very interesting. There is a buy for each sell, and we have actually opened up a position that benefits or has a max benefit right here at its peak of $12.50, which is basically where I think American Airlines belongs. So here in this situation, you can risk $13 to make a maximum profit of $37, or basically turn $13 into $50. Now I quickly want to show you the same type of position on Tesla right now. So if I were to do a 140 sell call as my anchor, and then I go down and I buy the 137, I'm actually going to create a $3 difference, because $1 is really not that much, and it's probably not worth doing because you do have to have 4 different legs here. You have to play with 4 different bid-ask spreads. So it's not really worth it to open up a $100 position here, but it does make sense to open up a $300 position here. Again, I'm gonna go into the custom order, create the custom order, and make sure that there is 1 sell for each buy. So there's 2 buys, I'm gonna have 2 sells. And now you can actually see where you can get a 10x return. In fact, this is a little bit larger than 10x. So as you can see, this is more than a 10x return. And if I were to open this position, basically my goal would be that Tesla ends right around $140. As long as it stays within this range, then I'm going to be perfectly okay, because I'm going to be in my profit zone. The only time that I'm going to get out of my profit zone is if the stock falls lower than 137 basically, or higher, then 143. And basically this is a very delicate position. It's not the easiest strategy to open at all. It's one of the hardest. However, when you are in this profit area, the feeling is amazing and you can actually be in this profit area a lot more than expected if you're using proper technical analysis.